Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What slide are you on, Nicole?
I'm on slide 15. Can you start it on slide 16? Maybe that's what's causing the issue.
Now I'm hung up here. Let's see what happens. Let's just try to keep talking as much as you can. I know that you can't remember every slide, but right now I'm stuck.
I'll bring up a PDF version of my slides. Again, if anyone would like a copy of the slides, please send an email to webinars@TradeKing.com, and my service team will get that out to you in short order. All right, so the next example that we were getting to, this is on slide 16, is just the setup of the ironfly, which is a combination of puts and calls together. Anytime you hear the word iron, that's all that it means, is calls and puts together. And the setup is very similar. You're going to buy 10 of the 110 puts, sell 10 of the 113 puts. That gives you a credit of $1.04. You're also going to do, and that's the short put spread. The other side of the ironfly is the short call spread. And that side of the short call spread is going to be the sell 10 of the 113 calls, buy 10 of the 116 calls, and that is for a credit of $1.50. When you bring those two spreads together, the total credit is $2.54 to buy 10 of the 110 puts, sell 10 of the 113 puts, sell 10 of the 113 calls, buy 10 of the 116 calls. And that gives you a credit of $2.54. Now, that may sound better at face value. The other two spreads we talked about, the call fly and the put fly, were for a debit of 45 cents. Now we're talking about taking a credit of $2.54 from the very beginning. That sounds great.
Looks like we lost Nicole.
Steve, can you hear me?
I can hear you, but I can't see that you're here again.
Okay.
Fortunately.
I'm under it as an attendee.
Okay, I'll just have to promote you again. Sorry about this. WebEx is not acting nice today.
Steve, do you want to run the slides?
That's what we'll do. I'll just drive them.
Yeah,
You're on slide. Slide 16, is that correct? Or slide
16.
Which one?
If you could power through to some of the builds there so that it shows.
Slide 17.
Oh, that's fine. So stay here. This is fine. All right. So as I was explaining, the credit is $2.54, and the maximum gain that you can make in this trade is $2.54, which is the same as it was almost to the penny of the call fly and the put fly. The difference is here you're collecting the credit up front. In the other trade you were paying a debit up front. But the risk and the reward is the same. Okay, you're still risking approximately 46 cents to make $2.54. Just because you collect the credit up front, it doesn't mean you get to keep that credit, right? Because you still need to close the trade and take the risk off in order to be able to do something with that credit, that money that you're hoping to earn. And so it doesn't really matter if you collect the credit up front or you pay a debit up front, it all comes out the same. Steve, why don't you go ahead and advance.
got it, Nicole.
All right, here. So I just want to show you a quick example of what the butterfly chains look like at TradeKing. We have 19 different types of chains that you can work from. Obviously, I've chosen the butterfly type. And you have the flexibility to vary the difference in the interval between the first two strikes and the second two strikes. You have, you can set those intervals the same or different depending on the type of strategy that you choose. And you can also trade directly from this chain in just a couple of clicks by selecting the strikes that you would like to trade. All right, moving on to the next slide. Now let's get back to why people trade long butterflies. We've just talked about capturing time decay. Let's move on to reducing risk and stopping out losses on slide, we'll go to slide 19. And just a recap before we get into the other reasons why people trade butterflies. They contain 3 legs. Those legs may consist of calls, puts, or both. If you have all calls or all puts, there will be 3 commissions for each one of those trades. And if you do an iron fly, it will involve 4 commissions because you will have 2 calls on one side and 2 puts on the other side. All right, moving on to slide 20. Let's get into how to reduce risk and still retain profit potential, as well as stop out losses and maybe be able to do better by breaking even or actually making some money back. So continuing on to slide 21, what we have here is, let's say that you have a forecast that a currency will weaken, and so therefore you expect the US dollar to strengthen. One way you can take advantage of that is to set up a long call spread. So let's say that the underlying is at 110, there's 32 days to go to expiration, and you forecast or you estimate that the underlying is going to move up in value to 113. Again, because the currency will weaken and the US dollar will strengthen. And so you've decided to use a long call spread, and you're going to buy 10 of the 110 calls and sell 10 of the 113 calls. That will give you a total debit of 135. To continue on within this slide, you'll see that your forecast happened to be correct. Can you continue on, Steve? Oh.
Doesn't let me click. Unfortunately, I don't have the capability. I guess you had a graph there, right?
Yeah. If you
Animations aren't working. Sorry.
Oh, okay. I'll talk you guys through it. Again, if you need a copy of the slides, webinars at TradeKing.com. Let me just pull it up here so I can see what I'm looking at. All right, so XYZ moves up to 113 as you expected, and the spread increases in value. So the spread that you bought for 135 has now gone up in value to be worth 195, right? Sounds great. You're up 60 cents per contract times the per share, right? Well, what could you do? One thing you can do is you could exit the trade right now and keep the 60-cent profit, less your commissions. That's not a bad way to go. Well, what if you thought that you still thought, though, that the underlying could hang out around the 113 level? You didn't think it was really going to move around too much. Is there something else you could do? And the answer is yes. What you can do is you can then sell a call spread, a different call spread, right? So you keep the call spread you own, which is the 110, 113 call spread. You bought that for $1.35. It's now worth $1.95. You decide that you want to sell a call spread on top of that, and you sell 10 of the 113 calls, and you buy 10 of the 116 calls. That trade, that credit spread, that call spread that you're selling, will bring in a credit of $1.55. All right, so you bought the first spread for $1.35. It has now gone up in value. You look to sell a second spread for $1.55. When you bring those two spreads together, you have the call fly setup that we talked about at the very beginning. The difference here, though, is that call fly, which was a debit in our example of 45 cents at the beginning of the seminar, that call fly, you now own it, though, for a 20-cent credit. A 20-cent credit, well, what does that mean? That means that you own a spread that if you put it on all as one, right, you put on your butterfly all at the beginning, it would have cost you a debit. Now you're legging into the butterfly spread by using two spreads at two different times. You can do that for a credit. That means you can never lose that 20 cents. Okay, that means you have locked in a minimum gain in this trade of 20 cents. Okay, with the potential to earn more if the underlying stays at 113 as you expect it to. Okay, now I realize that this is not your everyday setup here, but any questions about this, please post them, and I'll continue to answer them. But just I want to make this clear here. All right, yeah, that's a good slide to be on, Steve. That's good. So if you stay in this spread, in this new butterfly spread, and the underlying remains close to 113, you can make the maximum profit of the difference between the strike prices, which we said is $3 in this case, plus, though, you don't have a debit to deduct, it's actually a credit. The maximum gain in this trade actually becomes $3.20 per contract, less commissions, okay? So if you think the spread is going to stay there, you think the underlying is going to remain close to 113, that might be a viable option. So to summarize, you have two choices here. You can exit the spread when it goes from 135 to 195 and make 60 cents per contract, or roughly $500 including commissions, or you can put on another spread, convert your original trade to a butterfly spread, lock in 20 cents that you can never lose, less commissions, plus a chance to make up to another $3,000 if you stay in the trade towards expiration. Now, as we mentioned, the likelihood of you making the maximum gain is low, but however, you do have a chance to make some amount in between the 20-cent credit and up. Okay, moving on there to slide 25. Let's talk about if things don't work out as well as that last example. Moving on to slide 26. I apologize, this also has what we call a graphical component, so I apologize that it's not coming through. But what's happening here is you've bought the spread, the same spread as before. Your target was for the underlying to move from 110 to 113, but in this case, it doesn't work out, and it actually declines to 107, okay? So the underlying has fallen, and your spread value has fallen as well. You paid 135, and it's now actually worth 85 cents. If you were to exit the spread right now, you would lock in a loss of 50 cents, and your position would be closed, and that would be the end of it. Hey, that's not such a bad thing. Losses are a part of trading, and the idea is to manage them so that you can continue to trade, not have your losses wipe out your account so that you're done trading and you can't ever come back. Okay, so losses are something to be managed. But what else could you do here? Well, if you think that the underlying is going to rebound between now and expiration, okay, so that means that you think it's going to come back higher from 107. You could put on that same, convert this spread into the same butterfly spread we just spoke of a moment ago, and sell the 113 calls and buy the 116 calls. At this time, with the underlying lower at 107, that spread is only worth 50 cents. So you would take in a credit of 50 cents by selling the 113 calls and buying the 116 calls. That would reduce the debit you paid initially of the 135, and now that cost of the whole butterfly spread would be 85 cents. In that case, what you have here is you've reduced your risk, but you're still in the trade. So what you want to evaluate, though, is the first scenario was if we just exit the trade altogether and take the loss and move on, that would be a loss to our account of 50 cents. Or we can convert this spread into a butterfly spread for an additional 35-cent total risk, right? We could have locked in 50-cent loss. Now we're putting on a butterfly spread for another 35 cents. Total maximum loss there would be 85 cents. But the difference is, though, we have a chance to make some of that money back if the underlying returns to a higher amount. It doesn't need to go to 113, which would give us the maximum gain, which would be unlikely. But if it starts to move back towards that direction, we have the chance to recoup some of the loss, maybe break even, maybe even make a small profit. So to go to slide 28, oh, it looks like it's working. There we go.
Amazing.
XYZ falls to 107. The spread now becomes worth 85 cents. Please continue. And this just recaps that the gross loss on the first scenario of just exiting altogether would be for 50 cents. If you continue on, you can then put on a second spread. Hit it one more time. And sell the call spread when the underlying is 107. You'll collect another 50 cents on that credit spread. That will reduce your overall risk to 85 cents with the chance to make some money on the upside if the underlying moves higher. Again, you'll have to factor in commissions to your analysis. If you move on to slide 28, there we go. These are your two choices to recap. Take the loss now and move on, which is a fine choice. You know, you need to evaluate what works for you, or reduce some of that initial risk and stay in the trade with a different outlook and see if you can make some of your money back. I will say this: if you think the underlying is going to stay at 107 or head lower, okay, that means that you've now changed from a bullish outlook to a bearish one or neutral. You would not convert your spread into a butterfly spread. It would not make sense for you to do it. You would either just waste money in commissions or just lose more money than you would have if you had just gotten out and taken the 50-cent loss. So definitely that's something to keep in mind.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.